Most people think you have to pay taxes on retirement income, but I'm going to show you exactly how we helped one of our clients legally pay zero on $100,000 of retirement income. And no, this does not involve any fancy Roth conversion strategies or even require you to have a Roth IRA in the first place. Now, I know what you might be thinking, this sounds too good to be true. But in fact, it's not. This is a real strategy that we helped our client keep more money in their pocket without complex loopholes or risky moves. So if you're hoping to make every dollar count in retirement, stick with me. I'll show you exactly how we made it happen for them. Now, before we dive into the strategy that lets you keep $100,000 tax-free in retirement, I think it's helpful to first see what $100,000 looks like in taxes if you're earning it as regular wages before retirement. Okay, so let's take a look at what it looks like for someone to earn $100,000 in wages. And the example we're going to look at is a married couple who are above age 65. So $100,000 of wages. And what we'll see here, there we go, total income $100,000. And then they have deductions of $32,300. So this is the standard deduction, which in 2024, the standard deduction is $29,200. But when you're age 65 and above, as a married couple, you can have an additional deduction amount. So each spouse that is above age 65 and up gets an additional $1,550. So that's where we're getting that deduction of $32,300. It's the $29,200 plus $1,550 for each of them. Now that puts their taxable income at $67,700 and their total federal tax at $7,660. Now, how we get to this taxable amount is you take that $67,700 and you apply it to the ordinary income bracket. And so for dollar amounts between $0 to $23,200, that's taxed at 10%. And then their income above $23,200 to $67,700 is taxed at the 12% rate. And so that would be what it looks like from a federal tax perspective. But we have to remember when you're working and you're paying wages, you're also subject to what are known as FICA taxes. And FICA taxes really has two components. It has Social Security at 6.2%, and then the Medicare charge, which is 1.45%, which is a total of 7.65%. So if I scroll down here, you'll actually see, there's their total federal tax. But when we explore FICA, which is the 7.65% tax, you'll see there we have FICA tax as well. So when we add federal and FICA taxes, just on $100,000 of wages, federal tax wise, plus FICA, you're looking at about $15,310. So roughly 85% is take home. The other 15% you're actually paying out. And again, this kind of creates the baseline of what it looks like when you're still working. But here's the exciting part. When you're retired, there's a lot of things you can do to keep all that $100,000 in your pocket instead of sending it to the IRS. Because while you're working, you don't have a ton of control over your tax bracket. But in retirement, you have multiple levers to pull, which allows you to create your own tax plan. So let me introduce you to a real client. Our clients, Dave and Sandy. They're a married couple in their late 60s who came to us looking for ways to keep more of their income in retirement without being hit hard by taxes. Now, each of them has Social Security. Dave's benefit was about $3,000 a month and Sandy's benefit about $2,300 a month. They had a joint brokerage account worth $600,000 and it was invested in a Vanguard S&P 500 index fund. Now, the dividend yield on their investments was around 1.2% in that fund, and the cost basis in that account was about $300,000. They also had an IRA account worth about $1 million. Now, here's the deal. It doesn't matter if your numbers don't match these because the principles I'm going to show you apply whether or not you have $100,000 or $1 million. Now, Dave and Sandy were a bit skeptical because they just assumed based on their numbers, there was no way they could avoid paying taxes, but that's exactly what we helped them do. And remember, everything I'm about to show you is something you can do, and it doesn't require any fancy strategies or things like Roth conversions. So first, let's take a closer look at Dave and Sandy's Social Security income to see how much of it would be tax-free. This income forms kind of like the floor of their retirement income, and understanding how it's taxed is crucial to building their tax-efficient retirement plan. And I've found a lot of retirees are surprised to learn that Social Security may not always be tax-free. And this is depending on what's called your provisional income, which includes half of your Social Security benefits plus other income. And so up to 85% of your benefits can become taxable. Okay, so let's start with the floor really of Dave and Sandy's Social Security benefits. So I'm going to go in here into gross Social Security, and I'm going to add in, so Dave's benefit of $3,000 a month would be $36,000 a year. And Sandy's benefit of $2,300 a month would be $27,600 over the course of the year. So with that Social Security floor, let's see how their taxable income is looking. Now, what we can see is we did add in their Social Security. You can see that the total gross Social Security is $63,600 is the combination of both their Social Security benefits, but you'll see that their total income is zero. And again, this has to do with what's known as provisional income. The more income you earn, the more of your Social Security benefits will be taxed. So they're in a range where their income is low enough that none of their Social Security benefits would be taxable. So at this point in time, with the Social Security that they have, they could get this Social Security and still pay $0 in taxes. Of course, we're still a far way off from the $100,000 mark we want to reach, but this creates our baseline and our floor. So now let's add in the next layer of income, which are dividends from Dave and Sandy's taxable investment account. And again, they have $600,000 in that S&P 500 index fund, which is generating a 1.2% dividend yield. So that adds another $7,200 of income, and we can add that to their tax return. So with that $7,200, we'll come in here, we'll add that in as a qualified dividend. So again, we have the $63,600 of gross Social Security. And now we have an additional $7,200 of dividends. And what we can see here is that their Social Security, again, is still $63,600. But what's happened now is with the addition of that dividend income, some Social Security benefits are beginning to become taxable, okay? Now their total income would be $10,700. But because of their deduction of $32,300, right, we're still in a place where taxable income is zero. So if we're keeping track of their income scoreboard, total income is now $70,800 and we still haven't paid any tax, but let's keep building to reach their $100,000 goal. So the next layer to Dave and Sandy's retirement income is strategic withdrawals from their IRA. Again, they have $1 million in their IRAs, so taking a small portion out can provide some income, but we do need to be careful to avoid pushing them over key tax thresholds. So if we go back into their income plan, right? So we have the gross Social Security, we've added in qualified dividends. And in this plan, what we're going to do is we're going to add in a $10,000 IRA distribution. Now, ultimately, it doesn't matter which IRA account we take it from. For this example, I'm just going to say we take it from Dave's IRA. So we add in $10,000 of IRA income, right? We have $63,600 of gross Social Security, $7,200 of dividends, and now we're adding in the $10,000 of IRA. So let's see what their tax situation is looking like now. Again, I continue to repeat this, but as you earn more income, more of your Social Security benefits can become taxable. So you've seen that of the gross, now $10,250 of their Social Security is taxable. Again, we've added in that $10,000 of IRA distribution. So it brings their total income to $27,450, and their deduction, once again, is still $32,300. So we're still in a place where we've now added in additional layers, but we're still at zero taxable income and zero tax. We're getting close, but we're not yet there at $100,000 of tax-free income. Now, the final layer is withdrawing from their brokerage account. Again, they have $600,000 in that taxable brokerage account with a cost basis of $300,000, which means that half of what they withdraw will be considered gains, and the other half is what's called a non-taxable return of basis. Now, typically selling investments could push you into a higher tax bracket, but here's where we can take advantage of what's called the 0% long-term capital gains rate for lower income levels. So by carefully selling $19,200 worth of investments, half of which are capital gains, the other half is a non-taxable return of basis, we would only be adding $9,600 of what are called long-term capital gains. Even though we could send them the full $19,200, only half of that would be taxable. So again, if we go into their tax plan, now again, we would generate $19,200 of income, but in order to create that cash, half of that would be taxable. So I'll go into here and we'll put in $9,600 is what's taxable of that $19,200. Okay. So at this point in time, between the Social Security, the dividends, the IRA distribution, and this distribution from the non-qualified account, we have officially reached our $100,000 income goal, but let's see how that shakes out. So as we'll see here, again, what's happened as more income is realized, once again, more Social Security benefits are becoming taxable. Their total income is now $45,210. Their deductions are $32,300. So you might be looking at this and saying, well, hold on. Total income is greater than deductions. And what you're showing me here is that their taxable income is $12,910. So did we just miss the mark? Did we ruin this plan? Did we not hit our goal of $100,000 of tax-free income? But not necessarily the case, because what you'll see here is that the way our tax system is set up, there's multiple different brackets. Social Security can be taxed at different levels. As you earn more income, more gets pulled up into being taxed. But there's also something what's called like the long-term capital gain bracket, which also applies to qualified dividends. And you'll see that they're in the level where we can recognize the long-term capital gains as well as some qualified dividends at the 0% rate. So while their ordinary income is also in that lowest bracket, they're also in the 0% rate for long-term capital gains and qualified dividends, which, although that taxable income is $12,910, it would not create any tax for them. So again, to recap, $63,600 of Social Security benefits, $7,200 of qualified dividends, $10,000 of an IRA distribution, and $19,200 from the brokerage account, half of which was taxable at a long-term capital gain rate, and we're able to get them into a position of $100,000 of retirement income and not a penny in federal taxes. So we showed Dave and Sandy that yes, they can achieve $100,000 tax-free this year, but I wanted to encourage them to think just beyond 1 year. While avoiding taxes now is great, we need to consider the impact of their tax strategy over their entire retirement. If Dave and Sandy ignore their IRAs for now, it'll continue to grow, which sounds good, but it could actually create a tax bomb later. Once they reach into their mid-70s, they'll be required to take required minimum distributions, which could push them into higher tax brackets. And this can mean higher taxes on their Social Security, potential exposure to IRMAA surcharges and Medicare premium, and more of their income taxed at ordinary income rates. So to avoid this, we could look into strategies like tax gain harvesting and Roth conversions while they're still in a lower bracket. Again, tax gain harvesting allows them to realize gains now at that 0% rate, resetting their cost basis and keeping future taxes lower. And Roth conversions, on the other hand, would allow them to transfer IRA funds into a Roth gradually, so future withdrawals are tax-free. And this planning now helps reduce their lifetime tax bill and minimizes the risk of a costly surprise down the line. So by following this strategy, Dave and Sandy managed to create $100,000 in annual income while paying $0 in federal taxes. So just imagine the freedom that brings not having to worry about taxes eating into your retirement lifestyle. But remember, this isn't just a one-year event. It's about setting up a tax-efficient strategy that will last a lifetime. By thinking ahead and considering options like Roth conversions, tax gain harvesting, you set yourself up to avoid future tax bombs and keep your lifetime tax bill as low as possible. So if you're in a similar position and want to learn about how Roth conversions can help you lower your lifetime tax bill, check out my next video where I walk through how I helped a client with all pre-tax money slash their retirement bill. I'll see you over in that video.